Hi, my name is FANY FAERUZA NABILA. Today, I want to talking about the monetary policy in Australia. Australia is officially known as the Commonwealth of Australia. It is an oceanic country with 7.6 million of total area. It has 6 states: New South Wales, Queensland, South Australia, Tasmania, Victoria, and Western Australia, and 2 major mainland territories, that is, the Australian Capital Territory and the Northern Territory. The capital of Australia is Canberra, with Sydney as the largest city in the country. In 2016, the estimate of total population in Australia is 24 million people. Australia is a constitutional monarchy with a federal division of power. It uses a parliamentary system of government with Prime Minister as the one who rules the system. The Australian dollar is the currency for the nation. Australia has no official language, but English always has been entrenched as de facto national language. Australia is a wealthy country. It generates its income from various sources, including mining-related exports, telecommunication, banking, and manufacturing. It has a market economy, a relative high GDP per capita, and a relatively low rate of poverty. In terms of average wealth, Australia ranks second in the world after Switzerland in 2013. Since 2008, inflation has typically been 2 until 3% and the base interest rate of 5 until 6%. So, what's actually the monetary policy is? The monetary policy is the macroeconomics policy laid down by the central banks. It involves the management of money supply and interest rate. The main set of economics policy is used by the government of country to achieve macroeconomics objectives like inflation, growth, consumption, and also liquidity. In 1911, legislation established the Commonwealth Bank of Australia, and then in 1959, this original body corporate was preserved as the Reserve Bank of Australia, or RBA, in legislation, specifically to carry on the central bank functions of the Commonwealth Bank, which had evolved over time. In Australia, the monetary policy of the Reserve Bank of Australia is aimed to, first, the stability of currency of Australia, and second is maintenance for employment of Australia, and the last is the economic prosperity and welfare of Australian people. These objectives are made more explicit with the adoption of the bank's inflation target. To quote from the latest statement on the conduct of monetary policy issued in October 2013, in pursuing the goal of medium-term price stability, both the Reserve Bank and the government agree on the objective of keeping consumer price inflation between 2 and 3% on average over the cycle. This formulation allows for the natural short-run variation in inflation over the cycle while preserving a clearly identifiable performance benchmark over time. How does the RBA use this inflation target to guide monetary policy? First, Australia's inflation target is an reflection of the average to be achieved over a period of years rather than a hard-edged band within which the inflation rate is to be confined in every period. There is sufficient flexibility for policy to take account of short-run development in employment and economic growth. In other words, there is some scope for policy to play a role in stabilizing short-run business cycle fluctuation. In the longer run, as the statement set out, the main contribution that monetary policy can make to growth and prosperity is to keep inflation low. The second point concerns the measurement and definition of inflation. The inflation target refers to the headline CPI, so the bank also looks at a measure of underlying inflation. Over time, measures of underlying inflation and the CPI move closer together, although the headline CPI is more volatile. It is more affected by temporary factors such as changes in petrol prices. The medium-term focus of the inflation target provides the bank with The centerpiece of the policy framework is an inflation target, under which the Reserve Bank sets the policy to achieve an inflation rate of 2 until 3% on average, a rate sufficiently low that it does not materially affect economic decisions in the community. The target provides discipline for monetary policy decision-making and serves as an anchor for private sector inflation expectations. The target is agreed between the bank and the government. So here the explanation of monetary policy framework delivered by the Governor of the Reserve Bank of Australia.
Yes. Well, the way we do that is we have a medium-term target for inflation, and we talk about holding CPI inflation to 2 to 3% on average over time. In other words, preserving the value of money. That's very important because a stable money is really a foundation for economic prosperity more generally. If we don't have stable money, then whatever else we do, we won't really be able to achieve broader economic prosperity. That framework's been in place since the early 1990s. We have hit the target. Over that 20-year period, the average inflation rate's pretty close to 2.5%. So we regard that as successful by the terms of the definition that we set ourselves, and I think that's made a big contribution to economic stability more generally. And I don't think it's an accident that that period of fairly low predictable inflation has coincided with pretty good sustained growth in the economy.
How are monetary policy decisions made? The formulation of monetary policy is the primary responsibility of the Reserve Bank Board. The board normally meets 11 times each year on the first Thursday of the month except in January. Hence, the dates of meetings are well known in advance. For each meeting, the bank's staff prepare a detailed account of developments in the Australian and international economies and in domestic and international financial market. The paper contains a recommendation for the policy decision. Senior staff attend the meeting and give presentations, while decisions by the Reserve Bank Board to change interest rates are communicated publicly on the day of the meeting at 2:30 p.m. The next question is, how is monetary policy implemented? Monetary policy is set in terms of an operating target for the cash rate, which is the interest rate on overnight loans made between institutions in the money market. The Reserve Bank exercises quite close control over the cash rate through its financial operation, and it functions as the policy instrument. When the Reserve Bank Board decides a change in a monetary policy should occur, it specifies a new target for the cash rate. It is periodically adjusted by decisions of the Reserve Bank Board, which are explained in the public statement announcing the decision. A decision to ease policy will reflect in a new lower target cash rates, while a decision to tighten policy will reflect in a decision by the Reserve Bank Board to set a new target for the cash rate is announced in media release, which states the new target for the cash rate, together with the reasons why the board has taken the decision to change it. This media release is distributed through electronic news services on the day on which the change is to take effect, the time when the bank normally announces its daily dealing intentions. The Reserve Bank uses its domestic market operation, or sometimes called by open market operation, to influence the cash rate. On the days when monetary policy is being changed, market operations are aimed at moving the cash rate to the new target level. Between changes in policy, the focus of market operation is on keeping cash rate close to the target by managing the supply of funds available to banks in the money market. The last question is, how does the monetary policy affect the economy? Let's find out. In describing the processes by which monetary policy affects the economy, it should be kept in mind that they are far from being purely mechanical in their operation. Predictions about the effects of policy actions are, like economic forecasts generally, always subject to uncertainty. The task of policy is to make decisions on the basis of the best available information, recognizing that these uncertainties exist. The general principle that short-term interest rate affect The general principle that short-term interest rates affect aggregate demands and activity to its important changes in trend for a broad measure of demand have generally been preceded by significant changes in the level of short-term interest rates. Substantial rises in the interest rate designed to restrain inflationary booms have been followed by contraction in demand. Conversely, substantial interest rate reduction have been followed by periods of significantly faster growth. In responding to cyclical developments and inflationary pressures, monetary policy has had a powerful influence on aggregate demand and economic activity. Well, that's all my explanation about the monetary policy in Australia. See ya!